Hey, it's Myra at Down Home Money, a simple approach to financial freedom. I hope you're doing well. It's Tuesday, and guess what? Today is my day. Great to be with you guys. And today, we're going to talk about a stock that I am actually buying every month, every week. I've been buying it quite a bit lately. I think it's a great play. I love the 45 cents dividend that it gives out every quarter. And it is in the oil industry. So if you're not into the energy, you may not want to hear about this stock. But I am talking about Enterprise Partners. So that's the stock I'm going to talk about today. EPD is the ticker symbol. And just a little bit about the company. Let me read to you a little bit about the company, and then I'll share with you how I feel about it. How's that? All right. So Enterprise Partners, Products Partners LP is one of the largest publicly traded partnerships and a leading North American provider of midstream energy services to producers and consumers of natural gas, NGLs, crude oil, refined products, and petrochemicals. Now, it is a master limited partnership, an MLP. So you will be taxed differently, and I want you to know this up front before you go buy some of these shares, because I think it's important you understand the tax advantages or disadvantages, whatever, however you feel. Everybody's different, and I love it. You will get a K1 every year for it. You are a partner in the company. So I love master limited partnerships, and that is what EPD is. So when you buy it, you need to know that. One of the little fascinating facts is this company was started in 1998 by Dan Duncan in Houston, Texas, and his daughter, his daughter and her three siblings inherited the company when he died. And one of the daughters, Randa Duncan Williams, is like the executive, let's see, what is she? Let me make sure I can tell you exactly what she's called. The non-executive chairman of the board. And so she's the only one that's still in the business apparently and runs the business on a day-to-day basis, I guess. But three siblings each hold 8%. And she's a billionaire, and she also owns Texas Monthly Magazine. So anyway, her and her sisters are the top richest women in the state of Texas. So that's pretty cool. But anyway, it is MLP is a company organized as a publicly traded partnership. And that's what this company is. There's about 7,130 employees. It's pipeline transportation sector. Their sales or revenue for last year was $26.67 billion. So just a few things I can tell you about them. Currently, the last ex-dividend date was 4/29/21. The PE ratio is 14.16. Daily volume is over 5 million. And that's just a few things about the company. Let me see. All right. Here we go. The dividend yield is 7.46%. The annual payout is $1.08. It's about 45 cents a share. They did have a raise in the last year. The payout ratio is 101%. So that may seem high to you, but again, it is an MLP. It has been paying out, having dividend increases for just less than 20 years. So that's good. It is ranked on a dividend tracker, which is something that I use, and I love it, as an overvalued stock by 16.10%. The historic estimate of value is $20.33, and the current price is $24.23 or so. So to share with you a little about an MLP, because there's some pros and cons. And my job is just to bring you some information. And you know, you're listening to a random girl over here on YouTube sharing information with you. You should always do your own research and check it out, because I'm a novice. I started dividend investing in March of 2020, and I've built a wonderful portfolio, and I share it with you. Of course, next video for next Tuesday, we'll have my monthly dividends for the month of June, and I'm sharing with you my ride to get to 100,000 a year in dividends. I started out, I wanted 20,000 a year, then I wanted 50,000 a year, and now I'm on my way to $100,000 a year through dividend investing. And you get to watch and be a part of this journey with me. But again, do your own research. I am a novice. And so you're listening to a novice girl on YouTube that is sharing what she's doing with her portfolio. I'm in the real estate industry. I've been in the real estate industry for over 30 years. I still own the first house that I bought. I built a rental portfolio that allowed me to quit my business and sell it at the age of 33, which allowed me then to live off my rental income. So then I became financially independent or financially free. And now I got back in real estate because I loved real estate and bought more property. And now I am selling some of my real estate because we're in such a high real estate market right now that I am taking my proceeds and I'm putting them in this dividend portfolio to throw me off an income. So enjoy the journey. You can check out my videos about some properties that I've sold. And then you can also check out my other videos about the dividends that I've invested in. And again, every month I share my dividends for the month and what I was paid. So EPD is a company that I am going to build up to $12,000 a year in. I have picked it as one of my stocks that just like AT&T, and y'all have seen those videos, and I'll put that up here. AT&T, I make $12,000 a year. I make $1,000 a month. They pay quarterly. Dividends pay either monthly or quarterly, and AT&T is a quarterly stock, so it pays me $3,000 a quarter, and I'm working on that with this one. So for me, I'm going to buy 6,700 shares of EPD. And that will throw me off $3,015 a quarter or $12,060 a year. And so my goal is to have so many stocks throw me at $12,000 a year, right? So right now, EPD is paying 45 cents a share. So with this stock that I've decided for the oil and gas sector, this is the one I've picked. It's an MLP. And I'm going to get up to 6,700 shares. Currently, I have 4,450 shares. I'm buying shares. I might buy 25 on Monday. I might buy 50 on Wednesday. I'm watching it, and I'm buying shares every week pretty much because I want to get to that 6,700 shares. And then I'll move to another stock, just like I did. I got AT&T to $12,000 a year. I'm going to get EPD to $12,000 a year, and then I'll find the next one that I'm going to do that with. So join the journey. Let me tell you a little bit about MLP. So we talked about that. So the federal government doesn't tax an MLP income and losses at the entity level. Instead, they are a pass-through to shareholders or partners. Thus, a shareholder of EPD stock avoids the double taxation inherited among standard corporate entities. And because of this structure, MLPs are incentivized to push generous cash income distributions. So, that's what I was saying earlier about the payout is over 100%. It's 101% payout. So there's a hefty yield for owning EPD stock. However, one of the less discussed concerns about MLPs is their potential for devastating losses. While income is often passed through to individual partners, so are liabilities. Nonetheless, to say, you must do extreme due diligence to pick the right MLP. Is EPD stock such a name? Let's discuss the positives. The primary driver for EPD oil is oil and gas demand. Although green energy companies like Tesla threaten fossil fuels on paper, for the foreseeable future, oil is still the king. It comes down to your preference. When you drill into the facts, Enterprise Products offers the benefits of MLPs, namely a generous dividend, while substantially migrating the risk via a robust and relevant midstream business. Furthermore, this business is levered to actual functionalities, which is fees, as opposed to unpredictability of the commodities market. Still, the company isn't perfect. Primary Enterprise, like other oil names, have been struggling to regain their mojo since the energy crisis of the last decade. A mastered limited partnership is a business venture that exists in the form of a publicly traded limited partnership. They combined the tax benefits of a private partnership, and profits are taxed only when the investors receive distributions with the liquidity of a publicly traded company. So some key takeaways about MLPs. A master limited partnership, MLP, is a company organized as a publicly traded partnership. MLPs combine private partnerships tax advantages with stock liquidity. MLPs have two types of partners: general partners who manage the MLP and oversee its operations, and limited partners who are investors in the MLP. Investors receive tax-sheltered distributions from the MLP. MLPs are considered low-risk, long-term investments providing a slow but steady distribution. MLPs are limited to the natural resources and real estate sectors. A master limited partnership trades on national exchanges. MLPs are situated to take advantage of cash flow because they are required to distribute all available cash to investors. So again, that's part of the 101% payout ratio. They can also help reduce the cost of capital in capital-intensive businesses such as the energy sector. The first MLP was organized in 1981. However, by 1987, Congress effectively limited the use of them to the real estate and natural resource sectors. These limitations were put in place out of concern over too much lost corporate tax revenue. MLPs do not pay federal income taxes. Understanding master limited partnerships. The MLP is a unique hybrid legal entity that combines elements of two business structures, a partnership and a corporation. First of all, it is considered the aggregate of its partners rather than a separate legal entity, as in the case of a corporation. Second, it technically has no employees. The general partners are responsible for providing all necessary operational services. The general partners usually hold a 2% stake in the venture and have the option to increase their ownership. Like a partnership, an MLP issues units instead of shares. However, these units are often traded on the national stock exchanges. The availability of exchanges offers significant liquidity. Traditional partnerships cannot offer this level of liquidity. Because these publicly traded units are not stock shares, those who invest in MLPs are commonly referred to as unit holders rather than shareholders. Those who buy into MLPs are often called limited partners. These unit holders are allocated a share of the MLP's income, deductions, loss, and credits. MLPs have two classes of partners, limited and general. Limited partners, which is what you would be if you bought into an MLP or EPD, are investors who purchase shares in the MLP and provide the capital for the entity's operations. They receive periodic distributions from the MLP, typically every quarter. Limited partners are also known as silent partners. Now let's talk about the tax treatment. An MLP is treated as a limited partnership for tax purposes. A limited partnership has a pass-through or flow-through tax structure. This taxing method means that all profits and losses are passed through to the limited partners. In other words, the MLP itself is not liable for corporate taxes on its revenues, as most incorporated businesses are. Instead, the owners or unit holder investors are only personally liable for the income taxes on their portion of the MLP's earnings. And then shareholders must also pay personal taxes on the income from their holdings. Further deductions such as depreciation, depletion also pass through to limited partners. Limited partners can use these deductions to reduce their taxable income. To maintain its pass-through status, at least 90% of the MLP's income must be qualifying income. Qualifying income includes income realized from the exploration, production, or transportation of natural resources or real estate. In other words, to qualify as an MLP, a company must generate all but 10% of its revenues from commodities, natural resources, or real estate activities. The definition of qualifying income reduces the sectors in which MLPs can operate. Quarterly distributions from the MLP are not unlike quarterly stock dividends, but they are treated at a return on capital as opposed to dividend income. So, if you're watching your income taxes and what you're paying in income taxes, here you go. So the unit holder does not pay income tax on the returns. Most of the earnings are tax deferred until the unit holder sells their portion. Then the earnings are taxed at a lower capital gain tax rate rather than at the higher personal income tax rate, thus offering significant additional tax benefits. And that's one of the reasons I'm buying EPD. Advantages and disadvantages of a master limited partnership. Like any investment, master limited partnerships have their pros and cons. Master limited partnerships may not work for all investors. Also, an investor must offset the disadvantages against any benefits of holding units of an MLP before they invest. Advantages of the master limited partnership. MLPs are known for offering slow investment opportunities. The slow returns stem from the fact that MLPs are often in slow-growing industries, like pipeline construction. This slow and steady growth means MLPs are low risk. They earn a stable income, often based on long-term service contracts. MLPs offer steady cash flow and consistent cash distributions. The cash distributions of an MLP usually grow slightly faster than inflation. For limited partners, 80 to 90% of the distributions are often tax deferred. Overall, this lets MLPs offer attractive income yields. That's why the yield's so high. Often substantially higher than the above average dividend yield on equities. Also, with the flow-through entity status and avoiding double taxation, more capital is available for future projects. The availability of capital keeps the MLP firm competitive in its industry. All right, so there's you some pros. Now let's talk about some disadvantages. Also, there's some benefits I want to share too in doing it with estate planning. When unit holder gifts or transfers the MLP units to beneficiaries, both unit holder and beneficiary avoid paying taxes during the time of transfer. The cost basis will readjust based on the market price during the time of transfer. Should the unit holder die and the investment pass to heirs, the fair market value is determined to be the value as the date of death. So that's something else. And it also says that earlier distributions are not taxed. So disadvantages. Let's talk some disadvantages. MLPs are extremely tax efficient for investors. However, the filing requirements for the business structure are complex. An MLP's income, deductions, credits, other items are detailed each year on an IRS K-1, Schedule K-1 form. Now, if you've never been in business before, whenever you own a business or maybe you have partners, you have an LLC, you get K-1s, S Corp, any kind of corporation, you're going to get a K-1. And the K-1 tells what you made, and that's how you will pay your taxes on that. So for this, K-1s will be sent out to investors. While K-1 forms create extra work for investors or the tax professional they hire, the structure of MLPs allows investors to avoid the double taxation that is typical of investments in C Corps. So also, as an added problem, some MLPs operate in multiple states, and the flow-through status of MLPs also holds on the state level. MLP investors are required to pay state income taxes on their allocated portions of income in each state in which the MLP operates, which increases their cost. So, another tax-related disadvantage of an MLP is that you cannot use a net loss. So more losses than profits to offset the other income. However, net losses may carry forward to the following year. When you eventually sell all your units, a net loss can then be used as a deduction against other income. A final negative is limited upside potential historically, but this is to be expected from an investment that is going to produce a gradual yet reliable income stream over years. So, very interesting, and I've learned a lot about MLPs. You know, I share with you all, I'm a novice, and I'm learning all the time, but EPD is an MLP based out of Texas, and, you know, I'm going all in. I'm going to have it providing me $12,000 a year, which is going to require me to buy 6,700 shares, and right now the shares are trading, let's see, what would that be? Let me get my trusty calculator here. Got to get my code in my phone, right? Okay, so right now they were trading for 24.23. They closed at. And if I times that by 6,700, that means I would need 162,000 in this investment to throw off the 12,000 a year. So if I take 12,000 a year and I divide that by 162,000, my rate of return is going to be about 7%. That's fantastic, you guys. Money in the bank, and that's what I'm doing. I'm selling some of my rental property and taking the proceeds, and instead of doing a 1031 exchange for more real estate and overpaying, because I know what's going to happen in the market, you can watch some of my videos about that, because right now the market is overinflated and it will come down. It's going to take some time. We've seen it before. We've been here before. We were here in 4, 5, 6 and part of 7, and then the market started going down. And then we were there for 9 when the market had totally crashed. So just be prepared for that. And so what I'm doing is I'm taking my money and investing it in stocks and MLPs and ETFs and mutual funds. You can see my portfolio. Come back for next Tuesday and you'll see my portfolio and what I'm making currently monthly on my dividend investments. So thank you so much. I'm great to be with you guys this week. And I can't wait to see you again next week. Be sure and subscribe. Give us a thumbs up. And again, I'm a novice, and it's so important for you to do your own research. I'm just sharing you my journey to dividend investing. And I hope it helps you and gives you some insight, because I'm bobbing and weaving all the time, and I'm feeling my way forward, and you get to watch. One more thing, don't forget, it's not how much money you make, it's how much money you keep and what you do with it. And are you buying dividend investments to throw you off a passive income? See you later.